Good morning and welcome to the Australian Early Finance Briefing for Thursday, the 2nd of July. I'm Nick Hurley. Okay, starting with gold, which tested its all-time high of US $1,800 an ounce over the last day. So some commentators are suggesting that the reason for the rally in the gold price is the anticipation of yield curve control, which is something we've mentioned in previous podcasts. So Bloomberg says over half of economists they surveyed anticipate the Fed will eventually set target yields for certain maturities of treasuries, with most saying an announcement could come in September. If this curve control does go ahead, it could spark a buy everything rally that ripples across credit, equities, gold, and EM. So, supporting this thesis, yields on 5-year Treasury notes sank to a record low on Tuesday. So, one analyst has supported the thesis that the intention is as much as the actual action of controlling the yield curve, saying that the effect is here already. With Treasury markets so controlled by the Fed, market-based price discovery has been crowded out by the central bank. Bonds offer almost no real yield and have therefore become cash parking assets. In this situation, gold becomes a much more attractive asset as a hedge to other markets and store of purchasing power. They're following on with this theme of Fed intervention. Prudential in the US has come out with an interesting perspective, saying that financial market concerns have become something like a new third mandate for the Fed Reserve, alongside its regular statutory objectives of price stability and, more recently as well, full employment. The Fed has underpinned this market and it's been complemented by monetary policy, says Prudential's chief market strategist. You may not like the fact that it has extinguished concepts of capitalism like creative destruction, but central banks refuse to allow market forces to take over. They don't want a complete collapse of the economy and the markets. Moving to China, we had some strong performance yesterday on the Shanghai and Shenzhen indices, which climbed 2%. These gains followed further evidence that China is building momentum after the large coronavirus hit. The Casein Manufacturing Purchasing Managers Index, PMI, came in at 51.2 for June. Anything above 50 is expansion. And that was also after growth in May. So the result reflected manufacturers' confidence that there would be further relaxation of pandemic controls and further normalisation of economic activity. Blackrock has come out with some analysis. They had a press briefing early this week with Mike Pyle, Global Chief Investment Strategist of Blackrock Investment Institute, has come out saying that we're likely to see the decades of globalization erode due to the coronavirus pandemic, leaving investors facing new risks as they emerge from the lockdowns. This is somewhat different to what we've been seeing in the numbers so far, where China's dominance of supply chains has actually been strengthened, bolstered by the rest of the world having to shut down for longer and heavier as a result of coronavirus. He says, we're all out of our normal lives, all working from home in the face of this very significant global event. The pandemic is exacerbating tensions between the US and China, forcing companies to reassess supply chains and how they do business around the world. Investors will need to rethink how they construct portfolios and carefully consider which specific regions of the globe will be the future engines of growth. He also cites inflation as a risk stemming from de-globalization. Globalization was a major factor in keeping inflation low, as we can certainly understand by Chinese imports being consistently cheaper over the years. So Larry Fink, the CEO of Blackrock, last month mentioned that it's still worth betting on equities in the long run, even though the coronavirus has rocked stock markets. and troubles may lie ahead. The only asset class over a long horizon that you can rest assured over long horizons that you're going to be safe with will be global equities. Who would have thought the CEO of the world's largest equity ETF manager would be saying something like that? And news coming up for later today, we've got the monthly exports, imports, and trade balance figures for May. We're looking at a 11% drop in exports, 10% drop in imports, with a positive trade balance of 8.8 billion Australian dollars. Looking to the markets, we've seen the ISM manufacturing PMI announced. It's come in at 52.6 for June, which is well above the forecast of 49.5 and above the previous month of 43.1. So strong news there for manufacturing in the US. The markets responded moderately positively, with the S&P up 43 basis points 7 minutes after open. And that's your Australian Early Finance Briefing for Thursday, the 2nd of July. Have a great day.